Let's see credit risk. We are saying the default risk. Default risk is non-payment of interest or principal or both. Usually the banks or the lenders, they wait for some time before thinking as a default. Okay, usually the period of default is set as depending on the prudency of the firm, as can be set as 30, 60 or 90 days after the due date. Okay, right. Now what is a bankruptcy risk? Bankruptcy risk is that the collateral would be possessed by the other party. So let's say suppose A has given money to B, and B has not returned the money, right? So the risk is that, okay, A would take over the collateral that B has deposited, right? Also, whatever the collateral that has been given to A, okay, it may happen that the liquidation value will be lower than the amount due. That is the idea. Okay. What is downgrade risk? Downgrade risk is the decrease in the credit worthiness of the counterparty. Usually the rating agencies, they will downgrade, right? So whenever the downgrade happens, okay, the creditors would charge a higher rate of interest from the downgraded entity, right? Note that because of this higher lending rate, okay, it may happen that it can cause more problem to the downgraded entity and it can further lead to the default risk, right? Now what is the settlement risk? Settlement risk from the perspective of derivative transaction, you can think of derivative transaction, OTC derivative. It's a that both the party have to commit the when the transaction settles at the end. So if the loser is losing money, he has to pay the money to the person who is gaining, right? However, it may happen that either party may dishonor the obligation. So let's say as an example, the long may dishonor or the short may dishonor. Okay, ideally it will be the loser who will dishonor the obligation, right? So that can result in settlement not happening of the derivative product. So think about it. Let's say you have party A, you have party B. Okay, party A is long in, let's say, sugar. Okay, right? Why? Because party A is, let's say, Coca-Cola company. Okay, it is using sugar as an input. Now let's say the price they have fixed of sugar was rupees 20 per kg with B. B is short in sugar at 20 per kg. Now think about the sugar price increase to 25. Okay, ideally A is thinking, okay, it will pay more to the supplier. From 20 it would pay 25, but it is thinking that it will receive the differential money of 5 rupees from B. Now think about at the end of the transaction, okay, when the expiry of the contract happens, this says that it cannot pay the money, right? So the issue with Coca-Cola is that it has to buy a sugar at a higher price, so it is effective price is not 20 per kg, right? So it is facing the settlement risk, right? Note that the default risk, credit risk, etc., we measure it through the loss given default and the probability of default. This gives us the expected loss given default into the probability of default, right? The way to hedge this credit risk by a lender would be it should diversify across industry, across borrower and the maturities. So it should diversify away.